In the month of January, we've seen a lot of economic data come through, and that economic data has been stronger than anticipated. For example, the JOLTS job openings were more than anticipated. There were more jobs in the market, and unemployment claims were less. Non-farm unemployment change increased significantly, and the unemployment rate dropped. All of this, you might say, is fantastic. It means the economic system is just chugging along, but there's a problem. And especially this week with the CPI data coming out, the markets may be in for some real turbulence. I'll explain how this is currently hitting the stock market and the crypto market, as well as commodities and Forex, and what you need to do to be prepared over the coming week. Let's run the numbers. Hi everyone, I'm Ken from CryptoTradingKS and the CTKS Method. My goal is to help you to become more of a financial and emotional blessing to yourself and those you love by breaking away from the retail mindset and understanding how markets really work. I seek to help you to level the playing field between the institutions and you. I don't want you to be exit liquidity, but you need to know what you're doing. If this sounds good to you and you're new to the community, please subscribe. And if you're not, welcome back, my friends, and I hope you had a fantastic weekend. What's happening inside the US at the moment, especially in the Californian fires, is just heartbreaking. And if you've been affected, our thoughts and love are with you. And also, if you're going through a life pullback at the moment, our love and healing thoughts are also with you. You're not alone, and the sun will come out again. Life, just like the markets, is always moving in a wave. It's always going up and down. But this is all about building your strength over time. If you go through a life pullback, know that the world is just conspiring for your advantage. It is always darkest before the dawn. It's easy to get confused by life and just think that life is all about just what you get, but it's literally about who you become as a human being. And becoming the best version of yourself is what it's all about. The next meeting of the FOMC is in about 17 days' time. And at that time, we currently have a 96.8% probability of no rate decrease. This has been on the cards for quite some time, but the problem is the stronger than anticipated economic data showing that the financial markets in the US and the underpinning GDP is strong are reducing the probability of forward rate decreases. In fact, the Fed may start increasing rates. This is what's pushing the 10-year, the 2-year, and the rate curves higher. And the basic problem is that when the rates go up, when the yields go up, that places negative price momentum into the major indices and also into crypto. But it's quite good for commodities, and you would have seen commodities just going for it recently. This is why. Inside the Masterclass in TM4, we look at break-even inflation rates and Bitcoin compared to that, and also the Nasdaq compared to that. We've seen a sharp increase in the M2 money stock. The M1 money stock is starting to come up. But the real issue is the 10-year break-even inflation rate, the 5-year break-even inflation rate, and the 5-year forward inflation rate. They're all starting to show significant signs of life. Now, when these things tick up, it's literally bad for the economic system because it pushes it into a shock. But it is typically quite good for long-term asset prices. At the current time, the Fed is seeing this spike in break-even inflation rates, and it's saying we need to do something about this. At best, we won't get a rate decrease, but at worst, we'll get a rate increase. From LV19, also inside the Masterclass, we look at major stock market indices, and we can see China's market has been coming down. Russia staged a bit of a rebound, but it's now under pressure. And we can see that Bitcoin has been rolling over, as well as the Nasdaq. The S&P 500 is not looking too well, the Dow, the Russell, and also Japan's market is weakening, as is the Aussie market. We are entering a period of turbulence. Now, turbulence is fantastic for traders, but really bad for investors. That's why you should have a certain percentage of your account for trading and a certain percentage account of your account for investing. Investors have the superpower of hanging on with diamond hands, and traders have the capability to get in and get out of the market quickly. Combine the two and you have a superpower. Recently, the put-call ratio experienced one of its largest bearish readings on history. And when you think about this, the market is getting really scared at the current time. They understand that the rate increases are literally around the corner. The problem is the market was expecting rate decreases. The market has recency bias. But when we look at the capitulation indicator, we can see that we've got a lot of fear inside the economic system, undoubtedly. And we need to look at the major indices to see how warranted or unwarranted this fear is. But we're currently seeing no signs of capitulation inside the crypto market and no blow off top either. One thing, and a question you need to ask yourself, if you got something like the C19 sell-off, would you do what every retail trader and investor does, which is be emotional and run and flee the market? If the answer is yes, you're not thinking the correct way about things. The market bias over the long term is always up. Why is that? Inflation. Inflation is literally baked into the economic system. The economic system is built on debt. So, if you get an opportunity to buy when prices come down, you want to take advantage of that. But these are very difficult to take advantage of unless you are a trader. And the thing to remember that most investors are in fact emotional traders. This comes to a shock for a lot of people, but if they think more clearly about it, it's absolutely true. When they typically get in when the market is going up, and they typically get out near the bottom when the market has just gone down for far too long. There is a way to combat this. I talk extensively about it in the new Profiting from CTKS Method structure. When we look at the major market indices such as the S&P 500, the Nasdaq, the Russell, the Dow, what we see is the association of Bitcoin with these major market indices is quite strong in terms of directional momentum and directional movement. That is, if the stock market continues to come down, we anticipate Bitcoin will be coming down with it. This is not a problem. Unfortunately, retail is only taught one thing, to go all in and more, and hope like hell it goes up. Hoping and praying have no part of a sensible strategy of investing or trading. Especially inside the crypto market where it's very common to see large drawdowns. This is just in a bull market, you can expect 30% plus drawdowns. And of course, when we look at the different cycles to where we are now, we are coming down when the last cycles were going up. So long as GDP growth and corporate earnings continue to expand, we know that the markets will continue to go up. They could have some turbulence in them. If they've got turbulence, that is a fantastic opportunity. It is not a reason to run. Bitcoin is open 24 hours a day, 7 days a week, and can give a fairly good insight into what the stock market could be doing. If the stock market is going up, it's a very good probability that Bitcoin has been leading the way because the stock market closes, but crypto never does. And if you want to learn how to trade in downward markets and make money, the CTKS Profiting from CTKS Method structure is the way to go. You'll gain institutional grade insight into what and how to look into markets to make money in any market condition. If you're looking at a chart, you need to know where the support and resistance levels are. There are two types of support and resistance levels. One is a recent indicative price or RIP level. This is the levels that retail draw up. They basically take a very small subsection of price and say that represents everything. Of course, that's statistically improbable. Instead, by using Level 1 and Level 2 standard certification, we can draw up structural levels that apply right across all time frames and are viewable in one hit. And we can see currently that Bitcoin is on a level of structure. Is it structural support or is it structural resistance? I'll just pop in some values for you here. So you can see this 94,574 level of structure. Price has come down into it and been stopped by it. If it can't get above, it's going to the level below. That is as simple as it gets. And if it can get above and take out its recent swing highs, it's going to the level above that, which would be 96,480. We know all these levels in advance. We know how strong they are. We know where the gaps are inside price. Given that the rates are going up and there's a lot of problems inside the market, negative structural attraction to the 93,656 mark is probable, but always have a three-dimensional strategy because the institutions love to get rid of any certainty inside financial markets. Now, how do we deal with uncertainty? We just have a process and a structure to deal with it. We know if it can't get above 94,574, it's going to 93,656. But if it does get above, it's going to 96,480. Our focus is looking at price action and what it's actually doing without any stories. We have a backdrop which allows us to understand that the yields are spiking. If the yields continue to spike, and that's been causing the DXY to go up and also the VIX to go up, if this continues, we're moving down. But if that abates, for example, the yields come down, the US 10, the US 2, the VIX comes down, junk bonds go up, and the DXY starts to retreat, that favors the 96,480 mark. In other words, to understand where your chart is going, you cannot just look at your chart. The charts that you need to look at from a structural perspective are these. Row 1 through to row 7. Row 1 and row 2 are very, very important. Row 1 and row 2 give you the risk on and risk off sentiment indicators, and you must look at the structural direction and structural momentum. The key word is structure. To gain an understanding of how all the different rows are traveling, you can pick up this watch list. The details are in the links in the description of this video. We can see in row 1, they're basically green. That is bad for the market. Row 2, they're basically red, except for gold. Gold is registering a great degree of stress inside the market. Row 3 of the major indices, they're all red. Row 3 reference are the futures of the major indices and futures of indices across the world. They are also all red. There's a lot of stress inside the markets at the moment, but it could be just starting. Don't freak out. Don't panic. Don't sell everything. Just understand how the market works. Row 5 is crypto. It is also negative. Row 5 reference, USD market cap dominance, is registering green, which means that there's a flow into the stable coins and out of crypto. This means that people are basically, it's like a proxy for the DXY. People are getting a little bit concerned about those rate increases, potentially. When we look at row 6, basically negative. Row 7, basically negative. The memes are negative. And the memes give you a very good risk on or risk off indication inside the market. They are very good to look at. And there will be a meme course coming out soon where you can gain a free trading view indicator for the structural levels. The critical row to look at the current time is the row 1 references. They're all green. This basically means that the futures of the VIX or the futures of volatility inside the market, it's going up. And when that happens, typically the market comes down. So all in all, from just a headline perspective, and we don't do headlines, we do detail. But from a headline perspective, we already know where the market is basically heading. Looking more deeply into the direction of the market, we're not looking structurally because structurally means we've got the indicators on. We just look directionally on the main channel. And when we look at the VIX, we can see when the VIX spiked up, what happened to Bitcoin? It basically fell from 108 all the way down to around that 92 mark. And what is the VIX currently doing? It's showing very prominent signs of life. We've got support here, we've got a cut over here. This is a bit of a problem because the VIX could spike up. Remember what the VIX spiking up did last time. Of course, do not panic, just get ready. And if you don't know how to get ready, you need to educate yourself, especially how markets work. And the Profiting from CTKS Method structure is a really good course for that. It will show you how to make money. The other thing to just bear in mind, the US 10-year is coming up. The 2-year is coming up very, very strongly. When the 2-year comes up strongly, that is not good for Bitcoin because the yields decrease the discounted cash flow and forward free cash flows of earnings of major companies. Well, all companies actually. But the major companies have a lot of weight inside major market indices. So when this happens, their valuations actually go down. And that's what causes so many problems inside the stock market. Now, when we look at this constant ascent of the yields coming up, the 10-year coming up, the 2-year coming up, look at this big spike. Look at the big spike here. Look at the big spike here. Look at the big spike there. What about the DXY? You're starting to gain a picture of underneath the headlines, moving more into the detail, but you must look at structure. And you can see all the yield curves are going up right across all the different maturities, and the VIX futures are also coming up. 2025 is going to be the year of the trader, not the year of the investor. If you're only in the crypto market like I am, you must look right across Forex, right across the indices. You'll need to know commodities. You'll need to know everything. It's kind of like tax law. If you want to give advice on tax law, you better know all of the tax law, not just a part of it. When we look at row 2, which are junk bonds, the euro dollar, the Aussie dollar, gold, silver, and copper, we can see very clearly that we're getting a decrease in junk bonds. And if you look at the blue line, which is Bitcoin, if junk bonds continues to fall, that is fueling the fire of the VIX coming up. And also the DXY, the US 10, the US 2 also coming up. Gold is very real yield dependent. And you can see that gold is coming up on geopolitical concerns. Gold is a safe haven flight. Whereas Bitcoin, even though it's digital gold and it's very readily convertible, it's very hard to take one gold bar into the local milk bar and say, I want some milk, please. Just shave a bit off my gold bar. But you can certainly do that with Bitcoin and other cryptos. But the thing to understand, Bitcoin is very risk sensitive. And there is a lot of risk inside the markets at the current time. Please make sure that you keep your eye on the VIX, the DXY, the US 10, and the US 2. When we look at the Russell 2000, we can see that it's been coming down and down and down. In fact, the major market indices are all rolling over. This doesn't mean that they just roll over and won't rebound. But if they form channels like this, down channels, any retracement that can't get past the upper boundary of these channels, just means it's a continuation of a downtrend. If it can get above, that's a completely different story. So we need to keep our eyes on things. And also you can see the weakening of the Russell 2000, which is the very red line here. You can see that weakening. And that just foretold us that we were going to get and find ourselves in a downtrend. And all the students from the Profiting from CTKS Method structure, you understand what I'm talking about if you're up to that particular week. What we can tell is the VIX is gaining strength to the upside. The VIX may come down, it may do a retracement before it goes up further, but you just be aware that the VIX has a lot of strength and momentum in it at the current time. The DXY also does. The Japanese yen also, the 10-year, the 2-year also. And we didn't talk too much about oil, but you can see it's got a very powerful uptrend. Just a quick point, on copper, it's been coming up. So we've seen broad-based rallies in the commodities sector, including oil. Therefore, seeing the commodity sector coming up, all of those commodities coming up and the yields exploding under inflationary pressure, and the euro dollar coming down, the Aussie dollar coming down, the junk coming down, we can see there's a little bit of a mixed message, but it means that risk off is hitting the markets. We have a confirmation. Now, one of the things that you'll need to do is think in terms of price waves. Just because price comes down doesn't mean it goes down and then won't come back up. It's always channeling, and this is something that you want to always bear in mind. As soon as it breaks out from a channel, that is a good sign. That means the buyers are starting to strengthen. And that's why we must look at the cheat sheet each and every day. Looking at row 3, which is the S&P 500, the Dow, the Nasdaq, and the Russell 2000. We can see that the S&P 500 is no doubt under pressure, and look at that blue line behind it, that is Bitcoin. Look at the directional correlation and association. What about the Nasdaq and Bitcoin? You can see it's going in the same direction. Therefore, if the Nasdaq breaks down and the S&P 500 breaks down, well, there's going to be fireworks inside the crypto market, and you must be prepared for it. Also remember, price is just moving in a wave. Yes, it comes down, but it does go back up again. What it's seeking to do is to always move between channel limits. So please keep this in mind. One thing to note, retail, as soon as you get any negative kind of action, 1929, the GFC will be talked about. It will be talked about everywhere. Price projections, 50% off, crashes, all of that stuff. Because retail is about emotion. If you're entering and exiting positions based on emotion, you are doing what a professional would never ever do. When we look from a slightly longer term, this is on the daily basis of the S&P 500, we can see that we've actually got a cut under. We've lost this support, and this is only just short-term support. We need to look at the structure to see how significant that actual cut is. But we've had a cut under and an underside retest and a resumption down. This actually favors more negative downside potential. Remember, price is moving in a wave. Just because it comes down hard doesn't mean it won't go up hard as well. This is the nature of price. Price is always moving in a wave. Retail influencers will be saying the targets to watch are the 57.23, the 56.07, and the 54.50 level. Now, why is this? Because they simply think in terms of liquidity sweeps and previous areas of structure. Is it incorrect? Absolutely. Why is it incorrect? Because it just doesn't take into account that the S&P 500 in this case has been trading for quite a while longer than approximately 126 days. Anybody who's been trained in statistics knows that you simply must get a reasonable sample size. 126 days over approximately 55,815 days is like literally not even 1%. It's a quarter of 1%. Can you imagine driving a car and only being able to see out of 1/4 of 1% of the windscreen? That would mean the windscreen is completely black except for 1/4 of 1% of the windscreen. How good would your driving be, especially if you're going at over 100 miles per hour? How safe would you be? There are a lot of free resources to help you out at CTKSmethod.org. The first thing that you'll want to do is to make sure that you understand the cheat sheet. The cheat sheet is really important, and you can download it absolutely free here from the homepage. And there are many helpful videos for you to help you to fill it out. The next thing that you would want to do from there is to join the service. The service is really, really good. It will save you so much time. And of course, doing the certification, you learn once and apply for a lifetime. All of these things are specifically designed to help you to be more of a financial and emotional blessing to yourself and those you love by teaching you how the institutions play inside the markets and pushing you away from the retail mindset. The CTKS method is the world's most powerful smart money buy and sell level detection system. And remember, I said retail influencers will be saying 57.23. That's around the area that we would anticipate getting structural support. How they say structural support and what structural support actually is completely different. Remember, how retail looks is just a percentage, a fraction of a percentage of total price history. That means statistically ineffective sample sizes. So let's just have a look at this 57.23 level. Without an awareness of structure, people just look at a retail level and say, that makes sense. It's going to do a liquidity sweep on this lower part of price history and probably come down to around there. But however, we know as professionals, this is not the issue. The issue is all of these nearly 56,000 days worth of data. And one thing that standard students understand, the structural levels change month on month, especially year on year. Now, how do we see these structural levels? You get this service indicator, or you can mark yourself. You mark the charts up yourself through level 1 and level 2 standard certification. One thing that you can see here, we've just tested this level of structural support. And from 57.65 through to 57.80, we have 2 levels of fairly reasonable structural support. And remember that structural so-called support at 57.23, it just doesn't even exist. Now don't forget, structure changes dynamically over time. And to understand this, you just need to understand level 1 and level 2 standard certification. Drawing these lines may seem like child's play. Hey, they're so easy. But actually, when it comes to certification, there's a lot in it. Now, what is the composition of level 1 standard certification? In level 1 standard certification, you learn all the foundations of how to draw up what's called SLs. SLs are very important to understand. And then in level 2 standard certification, that's where the rubber hits the road. Any chart marked up with level 1 standard certification and not level 2 standard certification is junk. This is very important to understand because a lot of people say, I can draw up level 1, okay, that's good, and that will give me everything. Absolutely no way. Level 1 is a foundation, level 2 is what you need. And it's the combination of level 1 and level 2 standard certification which pulls everything together. It is the most significant advancement in 270 years of candlestick technical analysis. Level 1 and level 2 standard certification applies to any price chart that can be represented in candlesticks, so it applies to just practically everything. When you look at gold, this price momentum may look pretty random. After all, what are we looking at? What is the total sample size here? It's literally 70,000 days worth of data. This is why the service is such a time saver, because basically the service levels are inside the indicator. Now I'll just put on some values for you here so you can see what these levels are. One thing that we can see with gold, it's come up really strongly because of all the fear inside the markets about yields and the Fed and so many other things, inflation. But every single chart is structurally bound. And at that 26.98 level, there was overhead structural resistance, which pushed it back to the 26.88 level. If we can't hold this level on gold, we'll start to come down, and we could come down relatively quickly because there's a lot of CTKS gaps in here. For example, as we try to come up to challenge that 26.72 from the 26.52 level, we enter what was called a positive CTKS gap. Now, these gaps don't have much of the way in terms of structure inside them. Therefore, they can get very volatile to the upside and also to the downside. Knowing where the structure is vitally important because if you're observing what can happen in price action, you must know where your structure is. It's not called the world's most powerful smart money and buy and sell level detection system for no reason. We've seen this time and time again. There was a case not too long ago when Bitcoin was just going ballistic, but it came into so much overhead structural resistance that we were saying it is likely to decay. That was last year. And that is exactly what it did. Knowing how to profit from CTKS structure is a superpower. And the most simple rule, if it's not going above, it's going to be negatively structurally attracted to the levels below. If it can get above, that's good. It will be positively structurally attracted to the level above. Structure is not complex, but the way to create it is quite complex. But it's worthwhile. You may be putting your life savings on the line. You better know where your support and resistance levels actually are, especially in times of extreme market uncertainty. And that's what we're entering right now. And the reason I say that, when we look at the VIX, we can see the VIX has done incredibly well. It's got a lot of support underneath it and it's breaking through. This could mean a very sharp spike in the VIX. And I was explaining before what happened to Bitcoin when we got that spike in the VIX right here. Remember, 108 to 92. VIX spikes matter. And unfortunately, a lot of people are just bound to the particular charts that they trade, and they have no concept at all that all charts are interconnected and intercorrelated. There are a ton of rules inside the stock market and also the crypto market. When Bitcoin goes up, that's that white line just here. When Bitcoin goes up, the alts will go up. When Bitcoin comes down, the alts will come down. It's a gravitational field and it is real. We would anticipate that for every 1% Bitcoin goes up, the alts will go up at least 2%. And it also applies in the negative direction. If Bitcoin is coming down, for each 1% Bitcoin comes down, we would anticipate 2% plus on the alts negatively. Bitcoin and the alts don't move by the same percentage as some people mistakenly think. That would mean all the alts are exactly the same as Bitcoin's line. You can see this has never been the case. And that's because we love the alts. That's why. Because we can get into them and we can make very juicy returns. But always remember, price is just moving in a wave. It goes up, it goes down, it goes up, it comes down, it goes up, it goes down. It's going in a wave. You just need to know which way the wave is going, and you assess that through the cheat sheet, which is completely free. We've covered an enormous amount of ground, and you've seen that 93,656 level was defended. Now we're coming into structural resistance at the 94,574. The key to understand, Bitcoin and total crypto market cap work in concert with each other. We're also coming up into a level of structural overhead resistance inside total crypto market cap. Fortunately, it is quite light, but we do have some levels above as well. But we do not have any levels below until we get back to around this area in price history. Therefore, if we reject the Bitcoin structural resistance level as it stands at the moment, we should come back to around this level in your price chart. We call that your money chart. I discussed this extensively in the Profiting from CTKS Method structure course, which is available from ctksmethod.org. Fortunately, we've seen a bit of reset. In terms of greed, we don't want the greed to be too high because that means a sell-off is likely. The greed is starting to reset. But we can see the liquidations across the past 24 hours are still quite high. A lot of people get into crypto because it's so volatile, but just please be aware that when you get liquidated under leverage, you can lose more than your account value. And this particular liquidation was 8.21 million on Bitcoin. They got wiped out. It's very important to keep your mind incredibly positive because the volatility of financial markets can cause a lot of grief and a lot of stress if you have a retail mindset. If you have a professional mindset, That's exactly the opposite. You want the volatility in, but always start small and scale. Don't go all in and just say, this is the bottom, because you'll soon find out it wasn't. Or if you're shorting, you will say, this is the top, and you will find out, just like those people who got liquidated, that it's not. That's why we must remain dedicated and committed. We either win or learn, and we never blame. Blaming is for retail. And whenever you blame, you cannot learn, so we focus on learning. The market simply pulls a huge amount of money together, and it pays people who can solve the problem of the market in those 24 hours and takes from those who can't solve the puzzle. Therefore, profit is all about raising your analytical strength. And it's also about your mind. All results come from the mind, and a better mind creates better outcomes. The way to get better outcomes is simply through better habits. You've got this, you can do this, and negative price action is not a problem. And no, the universe wants you to succeed. Opportunities in life reset daily, and there's no step back without 2 steps forwards. Have a great day or night ahead, my friends, and Kate and I look forward to catching up with you again in the next video. Bye for now.